keep passing the tea and coffee list.
Thank you very much, everybody. How are we today? Good? Good? 2 thumbs up, everyone? Yep. Fantastic. Well, I've got a reputation to live up to, haven't I? I've got to crack a few gags. So yeah, I appreciate that this evening is very informal. And really what the purpose of today is just to share some knowledge with you guys. Everything that I tell you, as well as being really interesting and exciting, might be relevant to some of you as well. If not you, perhaps somebody you know, or perhaps something you might do in the future in terms of investments. But here we are. I've entitled this presentation called Don't Pay HMRC a Penny. Now, a quick straw poll if I may. Who pays tax? Anybody pay tax? Who would like to not pay tax? Anybody? It's not the same people. That's always the same. Well, I'm going to show you a number of different ways where you can do that. We specialise in a very niche area of taxation, but nevertheless it's a certain area which is very beneficial. I have to stand over this side because my fingers aren't long enough to press the page up, page down button. So, sorry about walking in front of the screen. Here we go. So yes, so what are you going to know this evening? You're going to learn a bit about us, a bit about the business, who we are, and what sort of things we get up to. You're going to learn a bit about general capital allowances, which is the subject matter for today. Types of properties that you can claim on, typical savings that you can expect to get if you claim these allowances, a few quirky tax reliefs, and a bit more information as well. And you'll be meeting my friend Bob a bit later on, and I'll need some audience participation through a few of you later on as well, so just to keep you on your toes there. So Bob's very important to us at Exact. So who are we? Well, who are we? We're property tax consultants. That sounds exciting, doesn't it? It doesn't obviously sound very exciting, but we save our clients lots of money off their tax bills, and that's why people like us. We started providing this niche area of tax advice back in 2006. There's a team of 7 of us based just outside of Cambridge. We all love Cambridge, world famous for the rowing, of course. And James is one of our members of the team, sat in the middle of the back there with the recording machine. So anybody that speaks will be on video forever. Be on YouTube tomorrow morning. So there's 7 of us working at our offices. We're a combination of tax specialists, tax advisors, professional surveyors we have as well, and many interesting people. I won't tell you too much about Pete. He's a bit of a legend in his own lunchtime, and that's another story. And where do we go? We cover the whole of the world. Can you believe it? We will go anywhere to satisfy these needs. We've had recently a survey done in Portugal. We've had one done in Florida recently, all for people who pay UK tax but own properties abroad. And in the UK as well. And it's a place that I like to have where it's got a great team spirit. I know that sounds cheesy, right? But it's important to me, and everybody loves coming to work, don't they, James? Yes. Of course they do. And we like to have a bit of fun as well, so that's good. We are a community and ethically aware company. I kind of made that phrase up, it sounds pretty good. We have lots of statements, and we give back to the community, which is important to me as well. So here we are, here's our offices. They look nice, don't they? Nice little quiet country offices. There, and here's a picture of the guys, well, 2 of them. James already with his thumbs up, and Tracy hard at work. Taken just this morning, when summertime has ended. Capital allowances. Now, some of you, I'm sure, will have heard of capital allowances. There's quite a few companies out there at the moment who are providing this kind of tax advice. Some are great, like us, and some are perhaps not so great, and I won't tell you which ones they are, you can work that out for yourselves. But effectively, capital allowances is an area of tax. There you go. An area of tax. It relates to certain items of tax reliefs. It covers a broad spectrum of tax reliefs. The main one we find is plant and machinery. But it relates to qualifying assets within qualifying buildings. Plant and machinery, as I like to call it, a slip there, typically are items with an expected life of less than 50 years. Now, would you believe it, the revenue have no definitive definition, no official definition of what plant and machinery is. There's kind of rules to say what plant and machinery isn't, but there's no rules to say what plant and machinery is. But plant and machinery is by far the biggest part of our business. We identify qualifying assets within properties, such as these things on here, this wonderful list of things. Heating, cooling, security installations, light, power, comfortable carpets and that sort of thing. They're all examples of what plant and machinery is. Most properties have them. But once you've got these capital allowances, you can do some great things with them. You can claim these allowances against any taxable income you have. So anybody here has got one of those jobs where you pay tax for your job? Sorry about that, madam. You've got a job. If you own qualifying properties, you can take the allowances that those properties attract, claim them against the tax that you pay in your job. How good does that sound? It's not witchcraft, it's legislation. You're allowed to do it. Sideways loss relief is the official terminology, but that's something you can do. That sounds good. Thumbs up? 2 thumbs up? Of course, yeah, that's a good thing. So you can claim these allowances against any income stream that you've got. Easy. It relates to a number of different properties. It relates to holiday lets. Anybody got a holiday let? There you go. John, it relates to the holiday let that you own. If it meets certain qualifying days in terms of rental, then there will be some allowances you can claim. It relates to commercial properties. And one of the reasons why I'm here, apart from seeing all you great people smiling and having fun, is because of Jay. Jay and I have conversed over the last 2 or 3 years probably. Yeah. And I went to the Property Super Conference that the Progressive guys put on in Chelsea. Not the best football stadium in the world, that's true, but you know, it's not Spurs. So we went to the Chelsea one, and I sat next to this chap and I said, talking to him, what do I do? Oh yes, I do capital allowances. He said, you're not Arthur, are you? I said, yes I am. He said, it's Jay, hello, how are you? So it's quite funny who you sit next to at these particular events, and hence he very kindly invited me down and put me in touch with the powers that be, to these guys here. So commercial properties, such as this one, this is deemed to be a commercial property. And a commercial property is basically any property which is traded with a view for a profit. So as long as it's not a residential home, then it can be deemed to be a commercial property. And you can also claim these capital allowances for some residential works as well. And we'll come on to communal areas in HMOs and also flat conversion allowance, which is quite a little sexy tax relief there that you should all be aware of. How much can you claim? Very roughly, you can claim anywhere between 8% and 150% of your investment. That's right. 8%, that's not so much, but 150%, that's quite a lot. So imagine if you spend £100, you could get £150 in tax relief. That sounds okay as well, doesn't it? It just keeps getting better and better. And I'll show you how that works. Now, the revenue, God bless them, we all know how an efficient, well-oiled machine the revenue is. A bit of sarcasm there for you. The revenue say that 96% of property owners have not maximised their capital allowances. That's quite a lot, I would say. You know, 96 is 24 out of every 25 properties have not had a claim for capital allowances on them. So that's something to be aware of. The main reason why people haven't claimed: 1, ignorance, not knowing that capital allowances exist. 2, the biggest thing that we find is that people say, yeah, my accountant deals with that, which is fine. Your accountant has dealt with it if he's organised for a surveyor to attend your properties and generated a revenue compliant claim report off the back of that, then they're fine. He's done that. Typically though, that tends not to happen. And it's not some new scheme. Some think it's some sort of a loophole. Who are the guys who have been in the press recently? Jimmy Carr, was it? No, Alan Carr. The comedian. Some sort of a scheme that's going on. Jimmy Carr, is it? Well, Alan Carr's the toothy fairy, whatever it's called. Him, and there's like Alex Ferguson and Redknapp. They've all been caught up in these schemes where they've got certain tax avoidance mechanisms, where offshore trusts and this kind of thing, employee benefit trusts. It's not a scheme. This is legislation. And this is what makes it so great. I don't have to try and make up and convince people that it's some sort of mechanism, some sort of scheme or something that is illegal. It's not. It's the law. The Capital Allowances Act 2001 allows you to claim this allowance. So it's not some new scheme. Now, does anybody know what year capital allowances were introduced? Have a guess. Madam at the front.
No idea.
Pick a number, any number.
2001.
2001. I'd see your logic there. Unfortunately not. A bit of a clue. Who likes history? History's favourite subject, anybody? Of course it is. We'll have a little quiz. What year was Benjamin Disraeli the Prime Minister? Roughly?
1870.
1870, that's a good answer, yeah. He introduced the Royal Titles Act on there and introduced the reformed the Education Act as well as a few other things. Good guess. What about the light bulb? The light bulb first used in Sir William Armstrong's house. What year was that? Anybody?
1902.
1902, very good guess. Very good guess. See, your knowledge on light bulbs is fantastic. Queen Victoria, God bless her, she was the Queen on this date as well. And all these coincided on one particular year. And that year, very close, if I had some sweets or something, I would give it to you, so you were closest. It was 1878. Capital allowances have been around since 1878. So it's not some newfangled scheme. To be fair, when they were first introduced, I'll do a bit of a history story, but the Treasury at the time, at the end of the 19th century, wasn't very rich. Now, I don't expect any sympathy, but one of the things they did is they looked at the overall taxes that they get in, and there was no real rules about how quickly businesses could depreciate their assets. So businesses being businesses, they depreciated their assets really quickly, which meant that they had less profits, which meant they had to pay less tax, which was fine. So from a business point of view, you don't have any tax to pay. From the Treasury's point of view, that wasn't so great, because it meant they were missing out on all of these tax receipts. So what they did is they introduced, in 1878, the wear and tear allowance, which is different to today's meaning of wear and tear allowance, so don't get confused about that. Anyway, and it basically set the depreciation rules, the tax depreciation rules for assets owned by businesses. And that still stands today. If you have a business and you depreciate the assets that you own, they're not tax deductible. You might have your profit and loss account, which shows depreciation of your assets, not tax deductible. You have to write those back, and your accountant writes those back. So to this day, instead of that, you can claim capital allowances. Not a lot of people know that. And of course, over time, it grew so that individuals could claim it as well. It changed its name, it was consolidated under some new rules. And in the last sort of 50 years, capital allowances were really used to encourage investment. So in a given year, you would be allowed to write off a certain percentage of your new assets in year one. So you would get big depreciation charge, capital allowances depreciation, and pay less tax. So yeah, that was exciting. That'll be useful on your pub quiz on Sunday night, I'm sure. But no, basically, if you've invested money in commercial properties, pub, holiday homes, communal areas of certain properties, then you, as an investor, yeah, as an entrepreneur, as a property person, are contributing to the economy. You increase the circulation of money doing so, generate business, using services, so you're entitled to get some tax relief. Well, that sounds fair, doesn't it? You know, you do something, you want something back. Let's do it. At this point, I'd like to introduce Bob. Now, he's not a criminal, much as you might think his photo looks on there. Bob is very exciting, believe it or not. Bob owns a number of different investments. But I'm going to show you how the type of property tax relief that he can claim is relevant to these various investments that he's got. He's got a small shop, Bob has. Guess what he sells in his shop? You'll never guess. He sells ties. Well, you could have guessed, I suppose, but he sells ties. We'll be here all night otherwise on that. But he sells ties in his shop. He's got a couple of old barns that he likes as well. He bought them as an investment and he wants to perhaps do some development on those. He's got some flats that he has just spent some money developing as well. And he's got a caravan, which, a bit of a sad story, the caravan, but I'll come on to that shortly. So this is Bob. Remember Bob, we'll be seeing him much, much later. Not that much later. So as I was saying, the main type of tax we get is plant and machinery allowances. Now here's a bit more of the sort of things that qualify. So you've got heating and air conditioning, lifts, wiring, emergency exits, window cleaning equipment. If any of you have got some window cleaning equipment stuck to your buildings, that will qualify. Firefighting, mechanical door closers, all those sorts, a whole host of things qualify as plant and machinery. And again, this isn't an exhaustive list, but it gives you an idea of some of the things most commonly found. Emergency lighting, air conditioning, heating installations are the main sort of things that we pick up on the majority of properties. And the rate of relief that you can claim on these allowances varies from 100% of these allowances all in year one to 8% on a reducing balance method. So this is the main thing that we identify. Now here's an exciting one. Also you can claim flat conversion allowances. Now this is perhaps going to be relevant to quite a few of you because you've all seen these rows of shops where they've got dead space above, maybe some flats or some storage for the shops or whatever it might be. A lot of people develop those and rent them out as flats. Now if you meet certain qualifying criteria, then you can claim this flat conversion allowance. It's quite valuable. One of my clients in London who had a property just north of the city, he did this on a pub. He bought a pub, changed it into flats, and he kept some of the ground floor as a commercial premises. And he was able to claim nearly £96,000 back from the taxman in flat conversion allowance. And yes, he did a good firm handshake and say thank you very much. So there's no problem any time. But he had to meet certain criteria. So these flats, as long as the overall building was not more than 4 stories high, it was finished before 1980, and the flats are not deemed to be high value flats, then a few other bits and pieces, you can qualify. This one makes me laugh. Each flat has no more than 4 rooms, ignoring kitchens, bathrooms and closets, bedrooms as well. So you think, I'm not quite sure what sort of properties you have down here in Hemel, but I don't know if there's any properties that have more than 4 rooms without the kitchens, bathrooms, bedrooms and a few other bits. Pretty nice flats if you ask me. And yes, so this is a really interesting one to get because dead space, you can all, I guess, appreciate the fact that you've all seen these shops where they've got these empty flats above. You probably think of them in your mind's eye now, where there are some just around the corner from where you live. There are. And you get hold of those, you can spend money and you're developing the property anyway, so you're getting your rental income, you're increasing the value of it, and you can get a whacky rate tax relief on top of that as well. So if that's part of your strategy, you've either done that or you want to do that for the future, just bear in mind this is something that could benefit you on there as well. And you get the rental income. So flat conversion allowance, excellent. Bob has spent £85,000 converting dead space above some shops into some living accommodation. So that's Bob. Bob spent some money on that. Flat conversion allowance. BPRA. I was just about to have a little competition to see if anybody knew what the acronym was, but obviously it says it on the first line. Building Premises Renovation Allowance. Yes? So if you think about it logically, it's an allowance for renovating business premises. I forgot for a second. So this was really designed, and again, a lot of these tax reliefs are designed to encourage people to use buildings that already exist. Rather than trying to find new space, let's just use cleverly the space that's already there. So this was really designed, it was brought in to bring back into use some derelict buildings. And a prime example of a particular case that's going on is an old barn. So a company we're working with, a firm of architects, wanted to design this barn, which is in a pretty sorry state, derelict, bring it back to life, and they wanted to extend to it and add a hotel. So convert the barn, that would be the main reception area for the hotel, and then add to it other parts, the bedrooms and swimming pools and this kind of thing. So they could claim a number of different tax reliefs. They could claim any money they spend at all converting this dead barn. They could claim building premises renovation allowance, only 100% tax relief on there, which is great. And if they were to extend that and build bedrooms for the hotel, they could claim plant and machinery allowances on those as well. So a very interesting tax relief, very valuable as well at 100%. And again, if it's something you're not thought about or something you potentially want to get into, then some more tea. You're a star. Service, Andy smile as well. So if you know of a dead old barn somewhere, it might not be the sort of thing that you're looking at, but think about it like this. You spend £100,000 developing that barn into commercial use. You could rent it out still as an office or what have you. You've got a capital improvement, capital asset you've gained as well, and also you can claim 100% of your costs back in year one under the building premises renovation allowance. Ordinarily, you still might go ahead and do that project and not know that you can get an additional £100,000 tax relief. So it's just something to be aware of.
Quick question. When you say unused commercial properties, what in reference to time frame, what does unused mean?
1 year.
1 year
So
unused.
it has to be derelict and 1 year. And it's consistent with the flat conversion allowance. It could be some properties that I've got have another one if you like. I don't mind. You like picture on tea? Okay. Sorry. So 1 year. So it has to be derelict and it has to be vacant for at least 1 year. And the same with the flat conversion allowance. If that's these dead spaces above shops, they have to be vacant for a year. They could still be flats above shops already, but they have to be vacant for a year on that. And it has just been extended. The Office for Budget Responsibility, Office for Tax Simplification, there's so many offices. They had a look at all the different tax reliefs that the revenue offer, and they kind of trimmed down a whole host of them. This was one of the few that they've actually extended, and the flat conversion allowance. So, again, might not be relevant to what you're doing, but still very, very interesting, and I think you'll agree, quite sexy as well as a tax relief. Now, not as sexy as land remediation relief, I'll have you know. The single biggest tax relief the revenue offer, at 150%. There's a few things that you need to know. So, if you have a contaminated land or building, you just so happen to have one, then any money you spend dealing with that contamination, treating that contamination, you can claim 150% of that cost and other associated costs against taxable income. So what does this mean? The typical things are asbestos in properties, Japanese knotweed, all love a bit of Japanese knotweed, don't we? Of course we do. Oil, petrol stations. You see these people buying up petrol stations. Do you know why they're doing it? As well as it's a great space to build some houses, but also they can claim 150% tax relief cleaning up that contaminated land. There's oil in the land, oil tanks, petrol everywhere, a whole host of rubbish in the land. They might spend £50,000 cleaning that up, taking out the tanks, backfilling it, topsoil, whatever it needs, whatever it takes. All of that money they spend on there, 150% of that they can claim against taxable income. That sounds good. 150%. I spend £1, I get £1.50 tax relief. Great. Even better, if my company makes a loss, because I've claimed this tax relief, I can surrender that loss for cash from the taxman. Great, you can get cash back for actually cleaning up land. Now, there's a few things. First of all, it can only be claimed by a company. So, it might be the case that you're looking to buy a piece of land, build some HMOs on that piece of land. Where better to look by set up a company, buy a contaminated piece of land. Oh, the petrol stations are great. Claim the tax relief through the company. You can build the HMOs in the company, and it will go years until you actually have to pay profits on the tax. Again, won't be relevant for all of you. Might be relevant for somebody you know, but now you're more educated in that if an opportunity comes along, you might have in the back of your mind, oh yes, contaminated land, a bit of asbestos in that old shed that I've just bought or something. Then you can claim that. You have to retain interest in the land for 7 years. Interesting word, that, interest, if that's not a doodle entendre or whatever they call it. Interest in the past used to be basically anybody that had a right, or anybody who had some sort of link with that piece of land. It could be the owner, it could be the leaseholder, it could be somebody who owned it 10 years ago, somebody who's got right of way. There was no definition of what interest meant. But in 2008, the revenue actually defined what interest meant. Now, it basically is the freeholder or the long-term leaseholder, in which case you'd be entitled to do that. Now, Bob, we all love Bob. Bob has some property, and he has some contaminated land, and he's going to spend £18,000 on this contaminated land to bring it back into good use to deal with that contamination. So that means he will be entitled to £27,000 of land remediation relief. Not him, his company that he owns as well. But we'll come on to Bob a bit more later. But land remediation relief, still sexy? Yes, it is. On there. Now, Bob has this old barn. He's got this old barn, and he bought it in 2006. As I said, as an investment, for 125,000. He wants to convert it into offices to let out. Sounds like a good idea, doesn't it? Yeah, it sounds like a good idea. He hasn't done anything yet. He knows there's asbestos there, and he wants to treat it. It's derelict, and he's going to put about £100,000 into the project through some joint venture owners, which he knows will put money in there and do it. So he's happy. He's happy. This is kind of how it goes. So I say to Bob, I say, yeah, £27,000 off your company's tax bill. He's quite interested in that. He gives me he's interested. There he is. Bob looks a bit interested. Now, that's not good, is it? Bit of sad news now. I don't want to be too upset, but Bob inherited from his nan in February a caravan. Obviously, Nanny passed away and left him a caravan valued at 35,000. She was a sweet old thing. There you go. But she's got a registered caravan on a registered caravan park. But he loved his nan, you know. He loved his nan, so he's going to keep hold of it. So I say to him, I said, look, it's a bit sad, Bob. All right, don't get ready to be excited. It's an upside and a downside. Every cloud and all that. And he didn't quite say. It was a bit sad, as he said. You know, his nan is choked up. But he got ready. I said, look, it's a caravan, Bob. Here's what you need to know. It's a caravan on a registered caravan park. Now the revenue, we've already touched on them briefly tonight. Great organisation. There's a certain bit of legislation that they issued under the Capital Allowances Act that says, I don't know why, it says if it is a caravan on a registered caravan park, not residential, for holidays, then that whole caravan is an item of plant and machinery in its entirety. Thank God my system has been cleaned. I feel much better. So the whole caravan is an item of plant and machinery. So Bob, all of a sudden, has got a £35,000 tax relief from this caravan that he owns, and he's quite happy. There's a few caveats, a few rules. It has to be regularly moved, and it can't be static, and it has to be treated as a holiday let mainly, but it qualifies. It's one of the peculiarities around capital allowances. Section 63, which I'm sure we've all read, of the Capital Allowances Act, it's riveting, says that Bob can then claim. So, there you go, Bob. Here's £35,000 towards reducing your tax bill. And of course, suddenly Nanny's parting isn't quite so upsetting for him, so he gets some money off his tax bill. Still exciting he is there. So here's Bob. Bob's got a great job. Bob has got a great job at the bank. Loves working at the bank. All sorts of exciting things going on there all the time. He's got £150,000 a year he gets in this job. That's not bad. I'd like a £150,000 a year job. That would be good. And he has these property investments, all of which make him £20,000 profits. This is kind of an overview of Bob. What Bob doesn't like is this bit here. You see this tax bill? His employers withhold tax of £63,000. That's not very good, is it? Hey, what do you do with £63,000? Well, he still has to pay a bit of national insurance, but at the moment his net income is £100,000. But it's £100,000. He's still got a job. He's pretty happy. I say, Bob, let's talk about this. You've got these properties. I'm sorry about your nan, Bob. Let's have a look at some of the things that we can do. So, we've said, you've got a shop. We did analysis. He can claim for the plant and machinery in his shop. And he can claim all of this £42,000 of plant and machinery, which are those things that we talked about before, on a writing down allowance basis. What this means is, he can't get it all at once. Because he's had it for a long time, he has to spread the cost of that depreciation over the useful economic life. That's a great way to put that one. Of the property. So, but he'll still get those £42,000 worth of allowances. That means he can earn this much before he starts paying tax. He gives me a thumbs up, he's happy with that. Flats, now, he's developed these flats which qualify for flat conversion allowance above a very nice set of shops. I think it was a pizza place. What are they all doing? Pizza place, bookies now, bookies everywhere, aren't there? Bookies everywhere, pizza shops and chicken probably. But he spent £85,000 developing these properties, and so he can claim flat conversion allowance for the whole amount, all at once. Great. His company has got a part ownership of the property, the derelict property where there was some asbestos. His company is going to undertake the work, spend the £18,000. The company can get the 150% land remediation relief, the £27,000. Great. Excellent. They've also, he's going to spend a further £99,000 developing that derelict barn, was it? I said, yeah, derelict barn into a nice set of offices that he can rent out. So he can get all of that BPRA at once as well. And God bless him, a little bit touching, he can still claim that caravan allowance as well. So great, he's got all this tax relief that he didn't even know that he had. So what does it mean? It means that Bob goes from £150,000 income, still gets that, thank you very much, as good as property profits, but now he can claim these two tax reliefs, which equal the £170,000 that he's earned. So all of a sudden, Bob's tax bill goes from £63,000 to a big fat nil. So he gets a cheque back from the tax man for the difference, which was 63,000, was it, I think? £63,220. So he's happy with that. Do you think he's happy with his £63,000 cheque? Yeah. Yes. Actually, yes, he was happy with that. And that means he can go on and invest elsewhere. So that just gives you an idea of the sorts of things that can be claimed. Obviously, Bob is a made-up character for those who thought he was real, but it just gives you an idea of the different kind of tax reliefs. And those who did think he was real, I'm sorry if I've upset you there. So, he's claimed some of the allowances that he has claimed, he's still got some left. So all of these, he can still claim, but over a number of years for the future. So once we've identified the allowances, we can start claiming them against chunks of profits or income, which is great. Does that not make sense?
Yeah.
That's pretty straightforward, I think, isn't it?
Does he make the claim against his earned income, or is it equal the tax he would have otherwise have to pay? Does it come off his income before tax, or does it come off the tax?
Okay, so in that scenario, employers still have to withhold the income tax, and then the allowances are first set off, if they're property-related allowances, they're set off against the property profits first, so his £20,000 of profits are offset. Then any other allowances he claims mean that his property portfolio makes a loss, so you've got a taxable income of 150, and you've got a big property loss, but the losses related to capital allowances, which are the majority of those, you can use those sideways against the profits you pay on the tax that you pay on your income. So therefore, he gets a reduced net taxable income. Did that make sense? No.
I think the final bit is the answer. So you've got £100,000 worth of allowances,
Yes.
allowable allowances.
Yes.
You've got £100,000 worth of income.
Yes.
Your income is reduced to zero. It's not, if you pay 40% tax on 40,000, you can spread it over 2.5 years.
Effectively,
You can't spread it over 2.5 years.
No, effectively, yeah, your income is reduced to zero. The amount of tax you get back is capped at how much tax you've paid. And invariably, a number of very funny clients come up to me and say, you know, I've got all these properties, all these allowances I can claim, haven't paid tax for the last 5 years. How much can I get back? The answer there is zero. Obviously, if you want a tax refund, you've got to pay tax in the first place to get some back. You can't get something for nothing unless you're claiming land remediation relief, but that's that. Did that satisfy your thirst?
Yes, thank you. Yeah.
Good. Talking of thirst. So who can claim? Good question. Who can claim? There's a few things. You must be a taxpayer or subject to UK tax. So charities who are outside the scope to tax, or government bodies which are outside the scope to tax, local authorities, a whole host of people that don't pay tax, there's no point in them claiming their capital allowances because they don't pay tax anyway. So it's unfortunate for me that a whole host of the really nice buildings that would have great tax reliefs are owned by people that don't pay tax. Pension funds are another one, and this kind of thing. So you have to pay tax to do that. So businesses that are in the UK that are subject to tax, individuals as well. You must use the assets in the course of a trade. So what I mean by that is that we had a case recently where a customer came to me and said, this is great, I've got this property, small office, and I bought it with the idea of tarting it up, making it look nicer, flipping it for a profit, and then selling it on, in a couple of years' time. I said, well, okay, that's fine. I said, how has your accountant treated it? And after some discussions, it turned out that his accountant didn't treat it as a fixed asset, i.e. wanting to generate long-term income. He treated it as work in progress, as trading stock. Therefore, not able to claim capital allowances. So that is not a long-term asset, it is trading stock. So therefore, treated completely different from a profit point of view and also an asset point of view. So if you have a long-term capital asset, then you can claim your capital allowances. Which is why a lot of developers, unless they hold their stock, and you'll see that a lot recently, you develop property, they can't sell all of the property. The ones that they can't sell, if they decide to keep hold of them and then rent them out, then that's treated differently from an accounting perspective, and they can claim capital allowances on those, but not on the property that they're holding to sell on, if that makes sense. Good, glad we cleared that one up. They've also incurred the capital expenditure, which is a bit of a strange statement, you might think, but if somebody gives you an asset, or more commonly, if you get a grant from an asset, you see, I think a lot of people now can get solar panels, these panels where people will pay to have the solar panels in there, but they take the money back off the feed into the grid. They're really not your assets. They might be sold to you at whatever price in the future, but you haven't incurred any capital expenditure in actually gaining those assets, so you're not entitled to claim the tax relief on those.
Does that mean you have to install all the plant and machinery? I mean, what happens if the place has got radiators and a boiler already?
Well, again, if you've already bought that, that would be part of your initial capital outlay of buying that property, so yes, you'll be able to claim for that. But if they're paying to have all the solar panels put in, then of course you're not, so therefore you're not entitled to claim. You cannot claim on dwellings. Now, dwellings is another interesting word, eh? The government, God bless them, the revenue, should I say, introduced the Capital Allowances Act in 2001, the latest version of it. In it, it says you cannot claim capital allowances on a dwelling. Great, thank you. And there was no actual definition of what a dwelling was. So, accountants being accountants, and I can say this as I am one, accountants being accountants looked at this fairly pragmatically, fairly logically, and I'll talk you through the logic here. So, you own a house, you rent out to somebody, one person, one family, two families, whatever it might be. Yeah, that is a dwelling. People live there, it's a dwelling. Therefore, capital allowances can't claim on a dwelling. That's a dwelling. Okay, so you can't claim on these multi-let properties or HMOs and that. Perfectly fine, that makes sense, you know, that logic. Then, in December 2008, only after it took them 7 years to actually do this, the revenue defined what a dwelling was. Dead exciting. They actually defined it as, a dwelling area was any area which a tenant inhabits in a private area. So anything behind the tenant's bedroom door was deemed to be a dwelling area. So, that's great. All of a sudden, that meant that any other area in a multi-occupancy property was a non-dwelling area. Therefore, you could claim capital allowances, plant and machinery, on all of the plant and machinery in those communal areas. Fantastic. And so who was the first person in the UK to identify that? Yeah, it was actually me. So, I looked at this and I spoke to the revenue and I said, so what you're saying is, only the tenant's bedrooms are dwelling areas? I said, yeah, that's perfectly fine. I said, right, okay. So all the other areas, just for clarification, are non-dwelling areas? Yeah, that's right, okay, fine. Can I have that in writing? Well, unfortunately, no, we can't do that. So, after consistently asking them to put this in writing, I still didn't get anywhere. Nevertheless, we have put in about 500 claims for capital allowances for HMO properties. And do you know how many have been rejected? Yeah, have a guess.
No.
A big fat zero. So our interpretation was completely correct of their issuing of guidance. Revenue Briefing 6608, that one, for those who really want to read it. Then, in October 2010, because a lot of capital allowance claims were going through, they issued another briefing statement, 4510, which basically went on to say that very clear and concise, black and white definition. There's a bit of sarcasm there as well. They said, okay, a dwelling area is an area which is necessary for private domestic existence. Yeah? Got that?
Yes.
Clear?
Yeah.
Private domestic existence. So what area in a multi-let is necessary for private domestic existence? Well, in the briefing statement it said bathrooms, living rooms and kitchens are all necessary. No, beg your pardon, it said living rooms and kitchens are necessary for private domestic existence. I'll go with that, you know, a boiled egg while you're eating Trisha in the afternoon is great, it's got to be done. It doesn't say anything about bathrooms. Now, I don't know how you guys operate here in Hemel, but I need a bathroom for my private domestic existence. I can't operate without it. But it didn't mention anything to do with bathrooms or kitchens. Sorry, it did mention kitchens. Another one of those examples is that of the revenue not being defined enough. It would be great if they could say, if somebody lives in a building, the whole house is deemed to be a dwelling. Fine. Then that would be very clear, very black and white. So to this day, we still service the needs of HMO owners. It is a lot more onerous in terms of the allowances that you can identify in the communal areas. Basically, you need to prove which communal areas of a property are not necessary for private domestic existence. And really, it just boils down to secondary reception rooms. I mean, you don't need a dining room if you've got a kitchen, breakfast room and a lounge for private domestic existence, and storage areas, which doesn't leave an awful lot of plant and machinery available for these communal areas of multi-lets. But just to give you an idea that, yes, you can still claim for capital allowances on HMOs, but the updated guidance really doesn't help and doesn't do a lot. If you have blocks of flats, that's completely different, because the flat itself is the area which is deemed to be a dwelling area, and all of the access areas. We've done one recently in Little Keynes, which was 46 flats or so, quite an impressive building. And it was quite obvious where the communal areas were. English is terrible today, I'm sorry about that. On that, but that's the kind of thing that is interesting, if you like that. You can, if you buy a property, what do you buy when you buy a property? Well, you buy the bricks, don't you? You buy the bricks, you buy the roof, you buy the foundations, you buy the carpets, you buy the wiring, you buy a whole host of items that's deemed to be plant and machinery. So as part of that initial purchase, what our skill is stripping out, metaphorically, the items which qualify for plant and machinery and value those items as a proportion of the overall cost of the property. So it could be on a commercial property such as this, perhaps 15 or 20% of its purchase price would be the equivalent value of plant and machinery with these very nice radiators and security bits and that kind of thing. And that's what we do, we strip out those items. And that's because you've already bought those as part of the purchase price. If you develop a property, which I know Jay has developed this as well, when you develop it, you incur expenditure related to plant and machinery, and you can claim for that as well. Any fit-out works, any expenditure indirectly to do with land remediation relief, if, heaven forbid, there was a bit of asbestos that Jay had to sort out at the back, and he had a contractor come in to deal with that, very dangerous substance. Obviously there would be more costs incurred rather than just replacing, remediating, encapsulating that contamination. There would be a share of Jay's time and some other administrative other costs as well on top, and all those things can be wrapped up in a claim for land remediation relief. The most, interestingly, the most dangerous thing that we normally claim for is unexploded shells. And I'm not saying landowners on the south coast are ruthless, because there's enough unexploded shells there anyway, but I wouldn't put it past them to drop one or two on the site that they're planning to develop. And of course, if there's one on the site, then you can claim for costs of cleaning the whole site up. But yes, land remediation relief as well, and derelict costs. So that gives you an idea of what can be claimed. Typical values we get here, modern offices, fit out, refurbishment costs, hotels. Gives you an idea of the typical values of the purchase price of these kinds of properties that are identified. But something else you should be aware of, we're all environmentally friendly people, we all drive economic nearly all drive economic vehicles around, and we want to be around for a long time. So something that you could do as an individual, as a HMO owner, is look at enhanced capital allowances. Now, I don't really need to do anything on this because it sells itself. There's an information portal here, www.eca.gov.uk. I'm sure you've all seen it anyway, but it basically lists all of the energy efficient assets that you can claim this tax relief on. So if you're thinking of putting a new boiler into your property, you might think, new boiler's broken down. Let's have a look at this list. There'll be a whole list of qualifying boilers that you can go and buy. So as well as the £500, £1,000 boiler cost, you can also claim additional enhanced capital allowances on the boiler, which is great. But keep an eye on this list because invariably assets drop off the list quite regularly. So you might buy something today, which then drops off tomorrow. It's pretty high cheese as far as that's concerned. But just something to do. And a lot of these things which are not necessarily relevant to residential properties, but still, you can still do these. If anybody has geothermal heating in their HMOs, then the quid's in as far as it's concerned. There's also an energy efficient water list, which I wasn't going to bore you with, and so decided to keep that out. So yes, something fairly big recently, which you should be aware of, is pooling. Now, we all like a bit of pooling. The Revenue have introduced something in April 2012, which means that there is an onus of responsibility on the vendor to identify what plant and machinery they're selling as part of the property. Now, imagine the scenario. You're selling your property and you don't really know much about capital allowances. So, your solicitors might guide you one way or the other, but you have to do this thing called pooling of capital allowances, pooling of assets. You don't really know what it's about. So your solicitor will probably say something like, well, let's just assume it's £1 or 0 or whatever it might be. We don't have to pay for a surveyor to do anything. We'll just put it as 0. It's off my desk. I don't need to worry about it. Fine. The sale goes through at £0 or £1 for the sake of argument. So imagine the vendor's surprise when imagine the buyer's surprise when he's bought this fantastic property. He's factored in that of this £100,000 purchase, I'm going to get £20,000 worth in capital allowances. Brilliant. More tax relief for me, huzzah. He then looks through the purchase contract, sale contract from the other side, and he realises that there's an election in there that says all of the plant and machinery he was going to claim for, he's now just bought for £1. So he's kind of a bit gutted at that. So this pooling is something that you have to do, and it's something that's more and more important. An example of this is that a client of ours bought an old B&Q site up in Yorkshire, and they bought it for just over £5.5 million. Now, they bought it from somebody who was fairly capital allowances savvy, and the solicitors didn't know anything about capital allowances, so they exchanged contracts. They waived the contract under our nose after it had been signed, and there was an election in there to say that all the plant and machinery they bought was for £1. So £5,599, £999 was building costs, and £1 was plant and machinery. So typically, we would expect to find on this kind of property about £1.6 million worth of plant and machinery in this, and instead the clients could actually claim the big fat amount of £1. So they weren't that impressed really that the solicitors had not highlighted this, and it cost them an extra £470,000 on their tax bill because of that.
Is there any comeback on the solicitor's firm?
No. There's no. Part of the problem is that there's no obligation until recently to actually identify what the assets are. There's CPSE inquiries which most solicitors exchange, and there's a section in there specifically for capital allowances, but invariably up until April this year it's just been 0 or not known. There's no obligation for them to disclose that. In terms of professional liability, you could argue the fact that they perhaps should have been looking out for it, but then they're not capital allowances specialists, they are conveyancing solicitors. I don't think they're using them still at the moment, but either way, this is an expensive mistake for people to make, and it could have been easily avoided. But something that you should be very much aware of, certainly selling a property if you expect to claim capital allowances. Now, I appreciate that tax is a really exciting subject. I know you want to get around to talking to each other, so there's a few more bits that we'll have a quick look at. A few things you should also know is, you've all done your tax return last January, yeah? Got it submitted in, all dead early, your accountant wasn't stressed or anything like that. End of January is when it's been submitted, yeah? That can still be changed. So you've got another year if you want to go back and change that. That's something that not a lot of people know. You think as soon as you've done it, that's it, it's gone, you don't have to do anything with it. If you were to claim capital allowances, you can easily just go back, change that tax return and submit it. Dead easy process, something you should be aware of. Not necessarily for this year, but for the future if you're investing. You can get a refund if you've paid tax in that year. We like a tax refund from the taxman? Yes, of course we do. And again, I'll just reiterate, the revenue saying that 96% of property owners aren't maximising their allowances. So what things that you should know? I would look for somebody, if I were you, who has a no plan. There's more people around than just me, so please feel free to have a look around. Choose somebody that's not going to charge you if there's no claim. Look for somebody who's not going to charge you for a separate surveying costs. A lot of companies say, charge me £500 for the survey, and then there's that cost as well. It's always good from a cash flow perspective if you don't have to pay for anything until you've got your refund back from the taxman. That's always a good thing for people to do. Note that it should be used against any taxable income, so if you have a job like this lovely lady in the front, then you can use your allowances on there. One big question we get up against capital gains. A lot of people say, well, if I claim my capital allowances today, surely, when I sell my property, I've kind of got to give it back. Absolutely not the case. A common misnomer. Capital allowances and capital gains are for two very different tax reliefs. So capital gains, obviously, is if you make a capital gain on your property, it increases in value and you're taxed on that. Capital allowances are a tax that you can claim for the assets you've invested in as depreciation against taxable income. So one's capital and one's revenue, for want of a better phrase. You want somebody who will work with your accountant to make it a seamless process. And obviously I would go for somebody that's got full PI cover and does have a 100% success record with the revenue. And just to let you know, again, it's not some fancy scheme, it's legislation. It's legislated under the Capital Allowances Act. I'll be honest with you, it's not the most exciting read I've ever had, but it's all there in black and white. Signed by Her Majesty the Queen in December 2001, I believe. So there you go. So that's kind of some more knowledge for you there. That's what we do, day in, day out, and I hope that hasn't been too boring. I don't think anybody's fallen asleep just yet. I don't know if you have any questions.
I was just wondering what sort of tax allowances you have on residential properties, if you're landlords.
If they're dwellings, then none.
Yeah, nothing at all.
No. If it's a regular single-let property to a house, no. Unless you want to do your energy efficient investment, you can claim for those, your enhanced capital allowances. But the dwelling part of it really restricts you from claiming anything to do with capital allowances on that. So I'm sorry, I made the rules up, unfortunately. But so there you go. So capital allowances is a great subject. I think it's perhaps not as exciting as you first thought out, but it's still very relevant. Even if you go forward and you think to yourself, okay, you might have an opportunity to buy commercial property or a dead piece of land or even an okay piece of land with some Japanese knotweed. All these opportunities are then stored in the back of your mind, or if there's somebody who you know who would benefit from it, just let me know. We'll be around for the foreseeable, and I look forward to talking to you a bit some more, individually.
Thank you very much.
Thank you.
Thank you.